You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today we've got Dr. Brian Romanchuk. Brian is a noted blogger, and he used to have a voice on fixed income and bond markets. He's an expert on the monetary system, so it's going to be awesome to talk to you, Brian. Thank you so much for being on the podcast. It's wonderful to have you.
Oh, okay, thanks. Yeah.
So Brian, I wanted to start by talking a bit about your background. So, how you got into business. And so, you started off in engineering, you did a PhD at Cambridge in control systems. So, how did you go from that to financial markets?
It's basically the quick run to the background. I was an electrical engineer, and there I sort of jerked into control engineering. Control engineering is a mathematical field, and weirdly enough, it's actually used in mainstream economics, optimal control theory, which is sort of a defunct branch of control theory. And it's the mathematics of modeling systems. And you're not, like, from an engineering perspective, you're not tied to a particular branch. Like, you're not tied to electrical or mechanical. What you're designing is, I need a controller to make a system do what I want. And could be chemical, could be mechanical. And like in aeronautics, like, how do you translate the pilot moves controls? How do you translate that to control action on the plane? So it's a theory of mathematical models. And so basically, I turned into, I was an electrical engineer, but I've turned into essentially an applied mathematician. And I was in academia. I was teaching at McGill, and I decided I wanted to get out of academia. And I ran into a guy who was working in the area in sort of finance as a researcher. So I played rugby with him. I ran into him and got an introduction, and so I applied, and they needed a quant analyst, and basically that's it. Like, there's a lot of programming, like in practice, because I also did a lot of basically I was all self-trained software engineer. And if you look at markets, most of your work as an analyst is dealing with data. You're getting data in from different formats, sticking it on a database, cleaning it, building models. Usually the model building is like 5% of the work, and 95% of the work is the data acquisition. If you're senior, if you're senior enough, hooray, you can dump that work on someone else. But usually it's you're getting the data, and that's actually where most of the effort is. But in terms of time, and then after that, once the data's in, okay, then you actually think about the models. So anyway, so that's sort of how the transition worked. My background, mathematics, and that was it. Like, I'm used to mathematics. What are the properties of mathematical models? How do you deal with that as a programmer? And so that sort of covered a lot of the things that wasn't finance. I mean, to learn finance, the CFA. I did I forget the terminology I'm supposed to use, but CFA charter holder. I went through that. So that covers a lot of the basics of finance. I mean, I had studied option pricing ahead of that. So I looked at option pricing, like the mathematics of it. So that wasn't, that sort of slightly tied to what I worked on. I mean, similar mathematics I ran into in control. And so option pricing, fixed income pricing, and general, and the rest I sort of picked up on the job. Where I worked, they were economists, but they were semi-conventional. Like they were had ties to heterodox economists like Hyman Minsky. And so I read a lot. The only economist I read that made any sense was actually Hyman Minsky. So I picked up a lot from him. So I was sort of a Minsky. And then later on, I went to the Caisse de Depot in Montreal, also in Montreal. And I worked as a quant, fixed income quant. Initially, sort of in the team that handled funding trade, provinces, swaps. And then later on, I headed up a new group of fixed income quants. But and then after that, I just moved in. I'm working part-time as a consultant and writing. And so that's why I ended up here.
Got it. Yeah, no, that's super cool. And your blog is bondeconomics.com. I think it's a fantastic place to learn a lot about how central banks, how the monetary system, how stuff like that works. And one thing that's let's start with what happened earlier this week. So earlier this week, the Fed hiked 75 basis points, and even though previously they said that they would only hike 50. And you published an article titled "Fed Panics," and so where you sort of said that this is a signal that they have thrown out whatever remains of the models that suggested that inflation is transitory, and so they are hiking until something breaks. So in the previous meeting when they did say that they weren't going to hike 75 basis points. So what is the value of forward guidance? Going ahead.
Well, yeah. So the forward guidance, it's they threw it away. Like, see, like just to step back, if you look at a bond, let's say a 2-year bond, you're comparing it, like if it's a 2-year treasury, you want to compare it to a risk-free short-term instrument. Like you could either hold a 2-year treasury, or you could sit in risk-free money market instruments that earn, the policy rate. Like when they set the rate, it's an interbank rate technically, but all the risk-free rates trade near that. So you basically have a choice. Do I want to own a 2-year treasury, or do I want to own or do I want to be in cash? That's the bonds rate. So you're saying from the bond point, you're saying what's the expected path over the next 2 years? If you're looking at 2 years, for the 5 years, what do you expect it to be over those, over that path? And that's where the forward guidance is. You sort of say, look, the Fed sort of says, oh, well, we're going to be hiking, we're going to be doing this. And so that implies a certain path for the Fed funds. And that implies, okay, this is roughly, there's a little bit of, a term premium, but it's telling you roughly, oh, this is where the 2 years should be. And the idea is that the forward guidance says, oh, well, we're kind of worried, or, normally they wouldn't say we're worried. Like you would say, oh, we're not that worried about inflation. If they think the 2 years too high, which they don't now, but like if you go back to like 10 years ago, oh, well, the market's pricing in too many rate hikes. So they'll say, well, we don't think it's going to go that high. And so they're trying to influence, like they set the short-term rate, but what they want to do is they want to push down longer term rates, which are priced off where where the markets are pricing, where is the overnight rate going to go. And like you have to go way back to last decade when they weren't worried about inflation. They were worried about low inflation. And so they wanted to, talk down too high a rate. And then conversely, if they think interest rates are too low, because the like mortgage rates, if they think the term rates are too low, mortgage, and it's too stimulative, they might want to talk up the bond, and that's to a certain extent, say, well, hey, we think bond yields are too low, and this, which implies, because the mortgages, like a fixed, like a 30-year mortgage in the U.S., its price is a spread off the treasury. So if they're too low, the mortgage rate ends up too low. And then, oh no, you say this is too stimulative. And so they might want to talk it up. They say, look, no, the bond market, no, you guys are too, you're too much exuberance in the bond market. So they want to be able to push around the bond yields by talking about it. And that's sort of the forward guidance. But the problem is, if they just start talking, they're totally contradictory, well, you don't pay attention to what they have to say anymore. And that's basically what's happened. I mean, to be honest, no one really should be trusting the central bank. The central banker is not going to, he's not in your interest. He's your, they want to move the bond yields around to meet an economic objective. They're not there to make bond investors money. If the bond investors lose, well, tough luck. They don't care. It's not their problem. So, from a bond investor point of view, you can't take everything a central bank says at face value. You have to be paranoid. As a bond investor, your job is to be paranoid about everything, because it's all contractual. It's all legal contractual obligation. And you're enforcing. You have contracts. You want to enforce them to get money, and you have to be paranoid about everyone and everything. And so you don't completely trust. So you need to know, like, the central bank does set the short rate. Like, you don't argue with that. But later on, you have to be a bit suspicious. But ideally, you say, well, if they think it's low, it gives you an idea of their thinking, and maybe you accept it, right? If they're basically saying we're not going to hike rates soon, well, maybe that's, you say, well, okay, probably you don't want to hike soon. But that's the thing, is that you have to be careful how much and how far, because normally they should know what they're going to do over the next few months, unless something blows up. Like, there's a crisis, like everybody knows. I mean, if there's a crisis, yeah, they cut rates. If inflation takes off, okay, maybe they'll hike rate. I mean, but that's the thing, is that for the hikes, it doesn't really make sense to hike 75, like to go 50, 50, 50, 75, 50. It doesn't really make sense, because like the whole curve, it's smoothed out. And you move a 25 basis point. If you add an extra 25 basis points, it's not that big a deal. Like, what people are worried about is, you say, look, at least before this week, you say, look, okay, now they're hiking at 50 basis points a meeting, which to a certain extent surprised me, but they were so far behind the curve. You're going 50, so you're just plotting out, okay, they're going to go 50 basis points a meeting until 3%. Now that got revised up. Like before this week, you say, okay, it's peaking around 3, so it's like 50, another 50, and it doesn't. Since it's averaged out, it doesn't really matter. Like, if you go 25, 50, 75, that averages out the same thing as 50, 50, 50. So, and moving it up, like, what really matters is the peak. The peaker is like, whether it's 3% or 4%, that's the big thing that matters. Whether, they get there, with an extra 25, if they add 25 bips, if they terminate at 3, it doesn't really matter, like, whether you went 75, 50, 50 or 50, 50, 50. It's not worth that much, because they're just going to get there. Maybe they get there half a meeting earlier. Well, so what? I mean, when you're averaging that over 10 years, which is like, for a 30-year mortgage, you're like, it's, it has like, it's not exactly the same thing, because a mortgage is amortized and it has options. So they're not compared. Like a 30-year mortgage has very little to do with 30-year treasury, because a 30-year treasury isn't amortizing. Like, it's very much back weighted, like the 30-year principals, where all the payments are in a low interest rate environment. Whereas a mortgage, you're playing the principal. So basically, like in the U.S., your 30-year mortgages is where the action is. And that's roughly a 10-year, 7-year treasury, at least it used to be. I'm not a mortgage expert. And so I mean, basically you say, how much you move, you move the 10-year by a few basis, it doesn't matter that much. Like, if you have a highly levered bet, like if you're highly levered, fixed income is interesting because every basis point matter. But if you're highly levered, you should know what you're doing. And, but generally speaking, for most people, you don't want to be highly levered in fixed income. And, so who cares? I mean, 25 basis points here or there doesn't matter for most things. And I mean, that's one of the problems is people get too excited about little micro stories about 10 basis. Like, no, it doesn't matter. Yeah, you have to take a bit of a big picture of these things. Like, yeah, 15 basis points matters a lot if if you got 2%, if you only have 2% equity in a rates position, yeah, hey, 98% leverage. Yeah. I mean, 10 basis points is interesting, but no, economically, it's not. So yeah. Anyway, so it was a bit of a long, but that's sort of like the big bad. That's sort of how I'm looking at it. But yeah, so see what the Fed did. They got backed in the corner about the 75. Like the only thing that really makes sense is if they want to do 75 each meeting, and that would the only reason to do that, because at 50 basis points a meeting, like if they're talking about a terminal like the finishing hikes at around 3 or 3.5, they're going to get there pretty fast. So it doesn't really matter. Like if they go at 50 or 75, it doesn't matter. But the only reason you might as well just do a 50, but like each per meeting, and then okay, you wait. The only reason you want to go 75 is you think they're really behind the curve and they need to go to like 4 or 5%, which should be for a bond for a bond investor be pretty scary because bond yields are not pricing a 5% Fed funds rate. And then, hey, that should be exciting. To a certain extent, the market, I think, immediately blew up a bit this week, but it's sort of come back from the last pricing. I haven't really looked. I saw some pricing this morning, but but yeah, basically the bond market isn't that convinced it's going to be shooting much more than 3.5% or whatever, because they're saying that either like the belief in the bond market is, I mean, there's two ways of interpreting. Like every investor has their own thing. But if you want to look at like how I would interpret the pricing, either investors believe that inflation will roll over for any number of reasons, or something blows up in the global economy, not necessarily the U.S. Like there's a lot of people who are worried about the U.S. economy. I don't track. Like I don't, since I don't trade. I'm not doing investment recommendations. I don't spend a whole lot of time agonizing over the data. I just look at fairly low key, and the housing market will slow because of higher interest rates, and that I would say is your major effect of the higher rates. But that's going to take time. It takes months to buy or sell a house. Houses are under construction. It takes months to finish a house. Like everyone is working on it. It's not going to stop dead outside of like a 2008 scenario where everyone's funding got cut off at the same time. But basically, 2008 was different. You had a hard stop on activity because funding market shut down. No one would loan money, and so nobody could do anything, and so it was just like a hard stop. Without that, even if you're really pessimistic on housing, it's got a low momentum. It's going to slow, and that slowing takes time. And realistically speaking, for the things that are going wrong in the global economy, because the energy spike and so forth, it's probably going to be blowing up a lot. If anything goes really wrong in the global economy, it's going to kick in before the U.S. housing market. So that's sort of, I would say, with the pricing is people say, yeah, inflation's bad. The Fed's going to keep hiking, but they're going to be forced to reverse because something is going to blow up. That's sort of what the pricing is saying to me. It's not like the the terminal rate isn't 5%, and basically saying now that something is going to derail it. Like, but if you sort of ignored all the energy price spike, if you just sort of looked at inflation, ignored what's happening in the world, you could say, well, why doesn't it go to 5? And like if you but you can't ignore everything's happening in the world. That's basically it. And that's the you could say if we can dodge a crisis, yeah, I mean the bond market still could be pricing too low a terminal height, but that's really sort of what I see. But not, the thing is, not like every person will put a different spin on it, but on average, all their positions average out to that view. Yeah, some people are more bullish, more bearish, but the market price is where everyone is sort of canceled out, and they can't move the price anymore.
Mm-hmm. Yeah, and you just sort of mentioned the impact of these rate hikes on housing. So one thing that's interesting is that a great deal of focus, especially among investors in the market, has been on labor market dynamics, where the labor market is usually described to be hot, or to be, usually described. We see that companies are finding it tough to hire good people, etc. And so, when it comes to these rate hikes, now how long does it take for the rate hikes to eventually pass into labor? Because that seems like the one thing that the Fed is keeping their focus on.
Yeah, that's the issue. So this is where I'm sort of the heterodox, so like a modern monetary theory, MMT, we're skeptical about the effect of interest rates on the economy. And I don't, like, from my point of view, like the labor market is companies hiring someone. That's it. Like they don't, and is anyone, I mean, outside of some weird places, like, maybe a mortgage broker or something, like outside of maybe some corner cases where your business literally depends on interest rates, why is an interest rate going to affect my hiring decision? It's going to be, is this person, that I'm trying to hire, they're going to add value? I'm in my short workers. Do I want to expand capacity? And that's where it's coming in. And you say, so it's not where it's coming in is, okay, expectations, because a lot of it is, okay, what do I, how do I feel about business in the future? And so it's through that channel. So it's, to the extent that the interest rates are going to affect things, it's going to be, will future business, so my word, the future business will slow. And that's it. How quickly would it show up? My guess is it's going, I mean, there's sort of two angles to it. The how it works quickly is the interest rate hikes will cause a panic in financial markets, and the currency markets do matter. The currency markets also affect.
So I think we just dropped connection. So you were talking about how currency markets were important, and
yeah, I guess like to your answer, I mean, I guess I should have given you a shorter answer, but there's two ways. One is the broad financial markets, including commodities, panic. Commodities and currencies, they panic because of the rate hikes, and that causes an immediate, oh, things are going bad, and people cut back. So and stock markets. That's sort of, there could be almost an immediate sort of drawback. But if you don't have a complete crisis in the various financial markets, why would people in the real economy, it's going to take time for them to say, oh well, maybe we'll slow down hiring. Like some people look at the stock market, they might worry, but not everyone does. Hiring processes are slow, so it's going to take time. And where you're going to probably see it, I mean, well, I'm a bug on housing problem and the housing construction, certainly like Canada, US, that'll slow. It's a major employer, and so that would slow, but that's going to take time. That takes time for it to filter in. And so that's it. So but that is going to be what they call long and variable lags. I mean, it'll take time for it to show up and for it to cool the housing market. But the thing is, whether is it cooling already? That's the other issue, because to a certain extent, people drop out of the labor market, things improve. I mean, as the pandemic sort of everyone gets used to it, there might be more people drawn back in. I mean, that's because that was part of the problem. You had people leaving, then you could have people coming back. So, it also might cool on its own. So yeah, it's hard to say what the exact effect. I mean, I don't have a strong opinion after that.
Yep. Yeah. And the other thing is that, so when it comes to credit growth, so one thing that we see on Twitter is that there are sort of two sides of the coin when it comes to inflation, deflation, and credit growth. It's that there's the group that says, hey, look, the Fed has been printing money. They've been printing trillions and trillions of dollars ever since the Great Recession. We are bound to see inflation. And the other side says, what the Fed is doing is not actually printing money. They're adding these things called bank reserves, which are not the spendable kind of money. They just sit there in an account. And how far do you agree with either side, and how far do you agree with that with the reserves earned money group?
Yeah. Well, the money printing. Yeah, that sort of sets my teeth on edge. I have some of my blog articles. Like, I have books, and one of them I have the title. It's a little bit of a joke, but it's Abolish Money from Economics. Like, anything involving money, people have problems. There's too much sort of mysticism about it. But like reserves, okay, technically they're money, so I'm not going to say, but they're in the monetary aggregates. But yeah, you can't spend them. It's like, what it is if you look at it, is the bank is leaving, the Fed, or Bank of Canada, central bank is a bank, but who banks with it are other banks, and they've got money. Like, what are called reserves? It's a bit of a misnomer, but that's what everyone calls it. But it's a deposit with banks with the central bank, and they can't really, they can shuffle it around, but they can't really take it out. Because they're basically just replacing treasury bills, or the equivalent, because the banks need liquid instruments, and it's just from their point of view. Okay, I can either buy a treasury bill and lend money to the federal government through the treasury, or I can leave the money on the deposit at the Fed. I mean, that's it. There, in both cases, the treasury owns the central bank, and so you're ultimately lending to the same entity. It's just a different package. It's just that one is included in money and one isn't. It's a little bit more complicated, but yeah, that I don't, it doesn't have that much of an effect. Like, to an extent, there's an alleged effect, is because it reduces bond yields, and even that, because the idea is that the Fed is buying them, taking out the bonds out of the market. So the idea is, well, there's an increased demand, so the price of the bond goes up, and prices and yields move in the opposite direction.
Right.
First thing you always have to remember as a bond investor: price up, yield down, vice versa.
Yeah.
So that's pushing down bond yields, but realistically, that's not. No one has a really good estimate of that effect, and I mean, I looked at it. I'm skeptical, but it's not that large an effect. No matter how you do it, you look at it. There's no one can really say this is a really big effect, and it's psychological. What it's come down to is everyone thinks it's inflationary. And this is the thing. It comes down to everyone believes that's inflationary, and the thing is, if everyone believes it to a certain extent, well, what can you do? Like, they're changing their behavior based on this belief, even though it makes no sense. And yeah, okay, and that's sort of what it's coming into sort of psychology. It's really like anthropology here. It's like you're trying to understand how other people are reacting to something that, like, it's, it's just sort of like a religious cult or of some sort. You're just saying, well, this is how they're reacting to it, and maybe it has an effect on the economy, but there isn't, it's not an obvious, like, people will say, well, if you like it's called the quantity theory of money. You increase the amount of money by 10%, prices have to rise by 10%. That's sort of the simplest version of the quantity theory. Yeah, that doesn't work. And but it could increase activity. And if everyone's if everyone sort of believes the prices will go up, well, actually, prices are set by people, and if people, they will raise prices. So yeah, it's sort of, it's very much a cycle, but none of it's reliable. Like, there's a psychological impact, like you could say, but you can't. You're going to have a very hard time isolating what the effect is. And if you go back, a decade, there was, inflation was stuck below 2%, and hey, they're printing money, and it did nothing. So it's sort of, all that's happened this time is inflation did finally rise, and everyone's running around saying, yeah, we told you. Yeah, but you told us that in Japan in the, the 2000s, and in everywhere else in the 2010s. And it did work then. And that's basically, I guess there's not much more to say than that.
Mm-hmm. Yeah, and the other thing that is interesting is, so when you read Warren Mosler's Soft Currency Economics, he talks about how banks lend when they want to lend, and then they borrow reserves in the market in order to meet whatever the reserve ratio requirement is. And so is that true? Is that the way banks actually work? Do they just lend?
Well, yeah, I mean one of the simplest ways of doing it is, you can just say, look at Canada before the pandemic, and they messed it up. If you look at Canada under, like, the modern Canada, they abolished reserve requirements.
Right.
They held zero reserves, and banks operated. If you look at it from the outside, they operated pretty much the same way that U.S. banks. You look at them, it's the same economic decision. Like, you could pick up a report. You talk to a bank analyst. Say, if you look at how do banks operate in Canada, how they operate in the U.S. In fact, Canadian banks operate in the U.S. They don't talk about, there's reserves. It's an arcane little rule regulation, and it doesn't really affect their decision making, because if you do have reserves, you just look at it and say, like, back in the day when there weren't excess reserves in the system, you just said, look, the central bank has a target for the Fed funds rate, and that is the rate for borrowed reserves. Banks could borrow, and if you're just short, if you, at the end of the day, you look, hey, we're short on our reserve position. They have to go in the market to get back to balance, and they don't know what's happening globally. Say, I'm sure, and so and you have to hit your reserve target. So if they have to pay whatever the rate is, like, it's not like they don't have an option. And on this, it's not like, oh, well, we'll miss it. No, they got to hit the target. So they got to borrow. They got to go in the Fed funds. And basically, if they're short, no matter what the price is, they're going to pay. And so there always has to be, the reserves, excess reserves have to, there always have to be reserves in the system to allow them to buy it at that price. And otherwise, it's going to blow away from where the central bank, like where the Fed wanted it to trade, because they have a target rate. Yeah. And if it moves too far away because there's a shortage, the New York, their open market, their desk has to go in. They have to do transactions that create reserves. Now, if there's too much reserves, back in the day, excess reserves didn't get reserves. They didn't get an interest on it, and people didn't want it. They would just dump it, and they would drive it below, and so they would have to drain it out, and that's it. So they would have no choice. They didn't just blindly, they had a target for the like where Fed funds trade, and so they had to have the right amount of reserves to hit that target. I mean, right now that's all out the window. Right now it's like there's an excess and they pay reserves, so they're indistinguishable from T-bills, and so nobody really cares anymore. So like they just, they have, if someone was actually short, they would borrow it and they get it because everyone has a huge excess of reserves. And in fact, since there are no reserve requirements in the U.S., actually they don't even need to do that anymore. They're just stuck. They're stuck with. We have a balance with the Fed. We could either buy a T-bill with it to get rid of it, because like if they buy a T-bill, whoever they're buying it from, they get the T-bill, they shoot away the reserves.
Yeah.
They lose the settlement balance is the better term. So you could reduce your settlement balance, but the thing is, whoever they're trading with, it goes to the banking system. So they lose the settlement balance. Well, guess what? The bank on the other end, like, because even if they buy the treasury bill from, let's say, a pension fund, the pension fund is going to have a correspondent bank. And hey, the bank on the other end of the transaction, hey, gets the settlement balance. So you get rid of it, the other guy has more. And that's it. But that's the thing, is you didn't worry about it. You don't, because you can't. You don't know, like when you're making a lending decision, you don't know when, like, you do expect the people generally, when they borrow money, they want to spend it. They might leave it in the bank for a while, but eventually the idea is that they're probably going to spend it. But then the thing is, you don't know when that's going to happen. So you're always managing on a day to day. You say, oh, we're short. Our liquidity position is short, and they have to do something about it. And that's what banks do.
Mm-hmm. And so when it comes to Fed policy, so what is the most the Fed can do in order to force the banks to lend? And short of, say, the government stepping in and guaranteeing all loans, how much power does the Fed have to actually get these banks to lend?
Oh, to lend. Well, I mean, see, now they probably want to slow it down, but like, if the problem, like you say, look at the last decade, where the problem was is that banks don't want to lend. Yeah, you're stuck. It's the pushing on a string. The idea is that what they do is they would lower, if they want to increase activity, they would cut the risk-free rate, and then hopefully that will induce people to go in and borrow. But I mean, it doesn't necessarily happen, because someone has to want, to borrow. You can't, the bank, the only way sort of a bank can sort of unilaterally increase the amount of loans it's making is to cut its own lending standards, because like they do credit checks, at least they're supposed to, and they'll have a standard. The only way sort of a bank could increase the amount of lending it's doing is we're gonna cut back our lending standards. But sooner or later they're going to be lending money to people whose business plan, well, actually we don't plan on paying this loan back, a thing like, at some point you don't want to make the loan. It's just not economic. And the Fed can sort of, like in a recession, banks tighten it, like they're pro-cyclical. They're going to tighten their lending standards because they're worried. The Fed could sort of go down, and they can sort of, rap knuckles, say, look, guys and gals, I guess nowadays, look, people, be, you're way too cautious here. Everything's going to come up roses. Loosen your lending standards. But generally speaking, bank regulators don't want to go around saying loosen lending standards. Like, the usual thing is, they're more worried about banks being irresponsible and making bad loans, because ultimately, like, that causes banks to blow up, and that doesn't look good from the regulators. The regulators, to the extent they're going to go after a thing, it's usually to say, hey, you guys are getting a little you people here are just a little bit, you're not, you're taking too much risk. But the hope, like the story, like the conventional story is, if you lower interest rates, people are going to want to borrow. Supply and demand. You lower the cost of money, people want to borrow more. Yeah, I don't know. I mean, that's sort of the hope. And it's what'll happen is the people who believe that will just keep adjusting the data until they're say, hey, look, we told you so. But they'll just keep changing around the data, because in general, people want to borrow when they see a need for fixed investment. Like for housing, yeah. For mortgages, people are very interest rate sensitive. That's how like interest rate policy.
Yep.
The conventional story works for housing because it is very interest rate sensitive. To a lesser extent, you see that with cars, like auto loans. But after that, businesses, on the business sector, businesses generally are looking at, they're looking at profit. I mean, this is the post-Keynesian story that, you're looking at, do I need to add capacity? And I'll invest. But if I'm not running at capacity, I'm not going to invest, because business firms' hurdle rates are way higher than the risk-free rate. Like typically, I mean, everything you hear, like it's like 20%. I've never heard anyone use a hurdle rate anything under 20%. It's like I expect to get 20% return on equity. And okay, maybe if they're borrowing, okay, they can lower their borrowing cost. But even then, that's a credit spread. It's not direct. There's a lot of gaps between the overnight risk-free rate and a term credit rate. Like, if corporate spreads are high, you can do whatever you want with the risk-free rate. That's not gonna cut corporate lending. And so it's generally speaking, where the interest rates matter, where it shows up in borrowing, it's on mortgages and autos, and that's it. And but right now that's not their problem. Is that, hey, things are a bit too exuberant, so they're slamming on the brakes.
Yeah. Okay, and the other thing is that when we were talking about QE just a little bit earlier, you mentioned that to an extent it reduces yields, but on the flip side, what we're seeing right now is QT. So how much of an impact does QT? Similarly, how much of an impact does QT actually have on the economy?
Yeah, I mean, but once again, I mean, how much? I mean, it should raise yield, but it's going to be hard.
Like how much when we see yields going up right now, how much of it is attributable to QT versus the fact the market is pricing in additional inflation?
Yeah, to be able to do it, you got to be able to predict bond yields accurately, and then you can say this is the effect. Like you can say, well, if you had an accurate model for bond yields, like if you were able to predict, here's where the bond yields are, and then you say, aha, now you can isolate the effect of QT. But you have to be able to predict the bond yields and then have this QT factor. But that's assume you have a model that can predict the bond, and that we don't get to that. That first stage is where the whole thing breaks down. No one really, I mean, to take independent facts, like I can predict the 10-year if you give me the 9-year and the 11-year. Yeah, I mean, sure, like no kidding. But if you sort of say, if you say based on factors not already in the yield curve, it's pretty hard to get a good estimate. Most of the models that people have are terrible, and that's the thing. If you've got a terrible bond yield model, well, what's the effect of QT? Well, what's the effect of a factor within a model that already can't predict the thing, and that's what you're up against. And it's like serious, like you wouldn't, you could do it. QT could have an effect. They dump all their bonds at once. Yeah, that'll have an effect. I mean, there's no doubt about that. But they aren't dumping all at once because they're not nuts. And that's the thing. It's like it's being done in a gradual fashion, and the the worries about where the terminal rate is going to dominate the effective QT. Maybe it's raised and maybe it's not. But look, I mean, bond yields have been jumping around 25 basis points a day, right? They're up, they're down, like 25 basis point a day. So, and that's probably about the QT effect is probably on the order of 25 basis points. So, I mean, when this thing is jumping around 25 basis points a day, an added what's an added 25 basis points on top of that, right? It's in the big picture. It's not, it's not big enough to say, well, if it was hundreds of basis points, then you could tell. But if it's like 25, who knows, right? And because no one can predict where it's going to be within 25 basis points. So that's that one.
Yeah, no, totally agree. And let's take a plane and go to Japan. And one thing that's interesting is, so Japan has the Japanese economy is typically based on importing raw materials and exporting finished goods. And so what we're seeing right now is stuff like oil and, broadly speaking, commodity prices being elevated. And obviously, some of the fraud has come down over the last few days, last few weeks. But then, broadly speaking, they're still elevated, and Japan is seeing the impact of that. And Japanese inflation, to an extent, is being celebrated by people like Kuroda-san, because Japan is finally seeing inflation. However, one would argue that this is not the good kind of inflation that comes along with economic growth. It's the bad kind of inflation because it's imported inflation. We're seeing we're seeing raw materials that get imported. We're seeing those prices go up. So I'm curious to hear your thoughts on the Japanese rates decision. So we're recording this on Friday, the 17th of June. So last night, I think it was the Bank of Japan decided that they are not going to change their policies of QQE or raise interest rates, and they just left that unchanged. And so what are your thoughts on that? What was your take when you read that, and do you think that's the right decision?
I'm not on top of it. I mean, I've seen people sort of go nuts about Japan again. Like, it's the widowmaker trade, and the people want. I mean, I got into finance in 1998. And actually, the widowmaker trade was old news even then in fixed income. It's just, see, the rates people, like actual people who trade interest rates, government bonds, they learned the hard way in the 90s. But it's the people who are not in rates that keep going back after it. They're credit, equity, commodity, and they just go, but they're not rates people, and they just keep doing the same thing. I'm not on top of the Japanese situation. But they, they're capping the yield, and they're just saying, oh, this will blow over, and they don't really, I guess they're not too worried about it because the import inflation, it's going to spike. Like, I guess, can oil prices double again? Well, I guess possibly, but it's more likely that something breaks. So you've had a huge spike. I mean, from the Japanese, I mean, it's not good, but it's probably you on the rate of change basis, that's it. I mean, you've had a level drop. Your what you can buy is dropped, and but the thing is, it's not, is that's going to continue? And that's the thing, is that I mean, the domestic labor, like I said, I can't. I mean, I would find it surprising that outside of those imported commodities, that things are changing, because the energy is embedded in everything. So prices will rise. So there's going to be a delayed reaction all through the production change. Higher energy costs will show up, but that's the thing, is that can it persist? And that's the thing. Obviously their decisions that they don't see it persisting, and then let's go back on the level. So I think that's people got excited about it, and well, the interesting thing about what they're doing is it's not just QE. They're actually saying we're capping the yield
The yield
on the
curve,
JGB.
25 bits. Yeah.
Yeah, and so where that's interesting is they're saying the price of the bond, and it's, betting against something with a fixed price is, to a certain extent. See, it's only if it moves below that, but if it stays at, near that fixed price, well, there isn't that much of a risk. And that's sort of the problem you have with currency pegs. It's very much like a currency peg situation, and because betting against it, it isn't that costly because it has to move away from the peg. I think yields did fall, so anyone shorting JGBs did take losses, but they're not I mean, I haven't seen the number, but I don't. It's not that large, at least compared to, let's say they either give up. If the things jump to 50 basis points, hey, they probably would have made a profit. And that's the thing, is that if they're keeping, if you're at the peg and the peg holds, okay, fine. You're just wasting a risk budget. You're wasting your balance sheet on something that didn't pay off. But if they do, depeg, hey, you got profit. So yeah, I mean, I think people might take a run at it. It's not crazy, but once they, where the craziness is where you start talking about hyperinflation, or you get people who don't know how Japanese finance works, and they're like really people are coming in and they're analyzing, they just make basic errors on what the Japanese budget is, because they don't understand the terminology, and they're reading wrong, and they're not just simple elementary checks. Like for a while there, you had people worried about, oh my gosh, their interest costs. No, their interest costs are, just look at, you just have to look at the numbers. There's no way that the interest costs are high. But the thing is they misunderstood what debt service, and they said, oh, look at this debt service. Well, the debt service included principal repayments. And guess what happens with the T-bill? You repay 100% of the principal on a T-bill. So yeah, they have a huge debt service because they're rolling over debt. And that's the thing, is like their debt service was not an interest service, which is, and this was from about a decade ago. And and that's the thing. You can't. This is the problem. But all you need to do was just look at the IMF database, and you wouldn't just say, look at the actual. No, their interest isn't a problem. But that's the thing, is that people are just digging into documents they don't understand, and they're making just elementary errors. They just simple back of the envelope say, no, that's wrong. So, but whatever. Basically, it's just free money for Japanese banks. These people are just providing free money. Everyone every 3-4 years, someone comes in, shorts JGBs, and hands over their capital to Japanese banks. And Japanese banks got to make money, or investors got to make money somehow. So whatever, it's just a little transfer. So,
Yes, sir. Yeah, and going back, I wanted to also ask you a little bit about MMT. And so, MMT, when you look at FinTwit, so financial Twitter, a lot of accounts on financial Twitter tend to adopt very strong right-wing libertarian views. Some typically of those like von Mises, Rothbard, and as a function of that, they tend to be heavily critical and heavily skeptical of ideas like MMT. So one, what are the biggest myths about MMT? And what do most people get wrong about it?
Yeah, see, what you see is finance. Yeah, they're definitely, it's a free market bias and libertarian. They're way more libertarians in finance and on Twitter, like and commentary broad. It's not necessarily in formal finance. Like they're basically, you wouldn't see not many Austrians actually trading government bonds. At least they do. They're not using their Austrian theory, shall we say, because it's you can get away with being an Austrian and predicting Japanese hyperinflation if you're a credit analyst or if you're a commodity analyst. It's not going to work if you're a rates analyst. So but yeah, MMT. It's. I mean, I ran into like Warren Mosler. He was in market, and so he has a like it's through there, and he had a firm, and they produce financial research. So you do have people might not be MMTers, but like from my point of view, like I read Minsky, and there's a lot of people who would quote Minsky, and there's a lot of overlap. Like in terms of how you look at government finance, what the MMTers are like a lot of the MMT story on government finance. If you're in rates, you might disagree with certain things, but to a certain extent, you can't have too strong objections to a lot of the what the MMTers are saying about government bonds. Like most of it, like would be the simplest sort of thing that you could say. The conventional view is, if you have government debt, the debt GDP ratio goes up. There's more supply of bonds, so the price falls, so interest rates go up. And that would be a sort of a conventional, you could call it a pre-MMT view. A lot of people would say that, and a lot of economists would say that. Across the board, it was pretty standard. And so if you wanted to lower interest rates, well, you have to run the surplus to get the debt GDP. That would, like in the 90s, that would be very common. And that's sort of like the MMT said, no, that's not true. But the thing is, if you were involved solely in rate, if your day job is trading rates, you have to be functionally enumerate to not realize, hey, wait a second here. Look at Japan. The high deficits, high debt GDP didn't raise interest rates, and that's it. The problem is that the people who believed all that never actually, they don't trade it. They don't look at the data. They just assume, well, so, the supply's up, so the price is down, and that's economics 101. It has to be true, and they don't actually, they'll maybe they'll take maybe a bond yield out of context, but they don't look at the time series. And he's looking, no, it doesn't work that way. So basically, that's sort of one of the sort of simplest parts of MMT. And what happened was, I mean, like in the 2010s, that's where a lot of the austerity was about that. And to be honest, those sorts of arguments, from a theoretical point of view, no, not too many people actually disagree with the MMT view anymore. So from my point of view, a lot of the debates are sort of non-debate. Like people are now debating the political side, like because there is certainly, like, you have MMT activists who have a political agenda. They're definitely progressive, and so it's moved away from a pure sort of economic theory, and they're arguing about policy implications. And so you've gotten away from sort of just, what is the theory of government finance, which I usually write about, we talk about. It's more about what should the government be doing. And that's where the fighting is about. And, but so, I mean, to sort of balance my thing, like I would say, look, for where the MMT debates were in the 2010s, MMT won, and everyone wants to just forget about it. They just said, yeah, we knew that all along. Where I mean, the complaint on the MMT it was about inflation, like theoretical. If we move away from the politics, was MMT politics bad? I mean, okay, fine. If you don't like because you don't have to be, and you could be like it's. I mean, there's nothing stopping you. Like you could believe in small government. Like Austrian economics, yeah, it's not really compatible. But but like from just if you just say political economy, I think a small government is better. Yeah, I mean, there's nothing stopping you. Like I mean, the MMT. Like if you say the government shouldn't exist, well, then you have a problem, the MMT, because hey, the government creates more, it's a monopolist. So that's what's hard. Like, if you think the government shouldn't exist, well, then you're starting to run into you have a theoretical, because you think the government shouldn't be a monopolist issuer of money. And that's sort of most of MMT is discussing, hey, it's a monopoly. But where getting back to, okay, where you would say MMTers dropped the ball is on the inflation forecast. And this is sort of, like I would immediately say, everyone, like the consensus dropped the ball on inflation. Everyone has thought it was transitory. I mean, I'm not a forecaster. And so, I'm not, I make, like, if someone makes a really stupid forecast, I know it's a stupid forecast in real time, I will make fun of it. But I don't, reasonable forecasts, I don't go back at people making mistakes. I might, but I shouldn't. I don't go after people's because I'm not a forecaster. So I'm not. I don't really go after it, other than, I guess, from a theoretical point of view, say, well, to a certain extent, like for a central bank. Well, if you're an inflation forecaster, if you're saying the central bank is an inflation forecaster, if you're not able to forecast inflation, that becomes a problem for the belief that thing. So I don't really. I think things are hard to forecast. So I don't pick after, like, my shtick is that I think things are hard to forecast. I think inflation is hard to forecast. So I don't laugh at people's wrong forecasts, because I think it's difficult to forecast. And that's the whole problem, that any simple model will break. That's my story. So if someone's model breaks, well, yeah, that's my view. That's what I'm saying. Yeah, that's going to happen. You got a simple inflation model, it's going to blow up. That's, so I don't pick on it, but where people are going after that, the MMTer, like the academic, the prominent MMTers were too dovish on inflation. And but that's the thing, is there's a small number of them, and it was a consensus view, and basically, if you look at it, most of them were, if you look at the academics, they lean progressive, and they're not inflation hawks, right? So it's to a certain extent, the people who were worried about it tended to be inflation hawks, who've been, worried about inflation for like the past decade. And but that's basically the real problem. There is another issue that should, like MMTers argue that the treasury, the fiscal side of government, should be more involved in controlling inflation. And you can say, well, governments, the treasury, like the fiscal side of governments, aren't doing a lot to help control inflation. And you can say, aha, I told you so. They're not doing that. But the problem is that literally everyone, the consensus is the central banks stop, and that's what they're told. The conventional, the mainstream views, they're screaming loudly, the central bank controls inflation, not the treasury. So, well, of course, if that's the view, if that, why would you expect other? Why would you expect the treasury to say we should be, you have to change the culture that, we've got to take inflation into account when we're doing our budgeting, and they say, look, we made a mistake. But that change in culture never happened. This is the thing. It's they're saying, oh, look, MMT failed. Look, none of the people in policy positions, or very few of them, are really, MMTers. Stephanie Kelton, okay, she was involved, but she's not in the treasury. She was involved with
Brian for prime minister.
The Democrats. But that's it. But they're if you look at the people in sort of Treasury, Ministry of Finance, and the central banker, they may or may not disagree, but they're not MMTers. The people making this, so the culture is not MMT. So blaming what policymakers do on MMT is bizarre, because they're not. I mean, it's just saying, well, we tried MMT. That's, you could say that they've done some things that are similar to what MMTers have done, but it's not what they were not exactly the policy recommendations. So it comes down to politics. A lot of it is just straight politics, and then the other thing is misrepresentation. And usually on Twitter, most critics, I mean, there are some good faith critics of MMT, but my rule of thumb is, if I see a random tweet if you give me a random tweet of someone saying something MMT, 99% chance is my odds that it's a bad faith critique. And that's it. I mean, I wrote a book about MMT and about, what are bad faith, and that's it. Like 99% of the time, it's just bad faith, and that's it. So, and that's what most of it is, and it's sort of, whatever. I mean, people arguing back and forth, basically repeating, anything where people are just sort of repeating their political views. I mean, they can be interesting for a while, but it's very repetitive. Like, the first time you see it's interesting, but when you see it for 100th time, it's not interesting. It's just the same things going. It's the same political arguments going over and over. And to a certain extent, I sort of bow out of it. And I generally have to look for like a longer, like if someone writes an article, I'll deal with it. But even then, most of us are bad faith. But but really, see, it's about inflation. But interestingly enough, like if you can say, well, the MMTers were wrong about inflation, that's actually, if you go back to the argument in the 2010s, the MMTers were saying there isn't a financial limit. Like you can't say, what is a financial limit? You can't just point to, there's a magical debt GDP level that you can't cross, right? That was the debate. But, it's actually, the MMT said, no, the problem, where your limit is for spending is when you start seeing inflation. So if you start complaining about inflation, and that's actually, you've accepted like that MMT premise, and you can say, well, the MMT weren't good at forecasting inflation. I mean, that's where you can say, aha, well, okay, fine. But, if you read the MMT, there isn't a whole, I mean, there are suggestions for making better, inflation forecasts, but they aren't. I mean, no one can go around saying, MMTers or tons, that it's all mathematical models and stuff, right? They're not selling MMT on the basis of, here, we've got these magical mathematical models to solve all our problems. And so, there are models, there's maybe not enough, but the models exist, but they're certainly not marketing themselves as solving all the problems. The reliance is on automatic stabilizers. I mean, that's sort of my view. Forecasting is too hard, so you rely on automatic stabilizers, and that's it. And you do sort of have to have seat of the pants estimates. And you can say, well, this inflation overshoot, it was, you would expected some, like that was the point. We avoided a deep depression at the cost of inflation. That was the policy trade-off. You knew when some inflation was going to hit. And the thing is, okay, it's overshot. Like it's all unprecedented. Okay, fine. So, you then have to do something about it. You have to tighten up. And, the question is, how quickly? And that comes down to, well, MMTers aren't demanding people to have, an immediate recession to deal with inflation, because it's a political view. What's worse, causing a hard landing and a deep recession, or having inflation running at 4% next year, right? What's the trade-off? And generally speaking, the MMT are the trade-off that, well, given a choice between a depression or 4% inflation, I'll take the 4% inflation. And the thing is, a lot of the hard money people will say, no, I'd rather have a depression, throw all the poor people out of work, and because I don't want the price of gasoline to go up or something like that, and that's it. And that it's a political trade-off, but that's the thing. Like there's no easy answer, and we just can't magically get inflation back to 2% without it might. But the odds are it's not going to go back to 2%. Just turn a dial. Oh, inflation's 2% again. It's the inflationary spike is going to burn out, and it's a question of, do we want to force it to burn out quickly with a deep recession, or do we just let it burn out? And that's a political trade-off, and that's not really MMT. That's political economy. What do you want to see happen? But people are obfuscating, blah blah blah. They, that there isn't politics, and it's just, there's a science, and you can just turn a dial, and boom, inflation goes away, and we'll have an optimal outcome.
Mm-hmm. Yep. To wrap up the podcast, Brian, I wanted to ask you, could you tell the audience a little bit about, where they can find more of your work and where they can find you, especially on places like Twitter?
Well, on Twitter, I'm either Romanchuk Brian or Brian Romanchuk. I think it's Romanchuk Brian. I've got books. See, hey,
you got a lot of them.
They actually they all look the same. I publish them. They're self-published, but they're available on all the most major online stores. Either as ebooks, which are cheap. They're way too cheap for their niche books. They should be more expensive. They're cheap. Or the paperbacks. They're relatively small. Like this was my first big understanding government finance. If you look at it, it's just have to get this on. See, they're thin. They're reports. They're not. If you think of them, they're novellas. Like if you want to put them in books thing, it's a novella. They're not novels. Novel length, it's a novella, like 40,000 words. They're shorter, but they're easy. But the idea is that it's perfect. Like an ebook, you don't care, but for a book, they are small. They're relatively small report, but they're just covered. The idea is that they're all you need to know, just brief, and then you can go for further. Like I don't want to pad it in with I need to make it a certain thickness and pad it with extra stuff. So obviously these are the only things I sell. So that's where ideally that's where I want my people to go. Because like the Twitter is free. I have a blog, bondeconomics.com, and I also have a Substack, and they're basically it's the same articles, but like I've got the ads on my web. But I have a Substack. Basically because the email support was dropped. So if you wanted to subscribe by email, you got to go to the Substack. But it's roughly the same material. And on Twitter, I'm on Twitter. It's mainly jokes. I do links, but I retweet interesting stuff. And then but yeah, the various books, like I have MMT, like it's fragmented by thing. I have like on understanding government finance, which is just straight government finance. It's MMT oriented, but it's not all MMT. It's just like MMT informed. It's conventional approach, and a discussion of what drives deficits, blah blah blah, bond yields. I have one on interest rate cycles, or discuss interest rates, and then I have it's modern monetary theory and the recovery, which is mainly an MMT primer, as well as a bit of a discussion of the recent history. I wrote it during the pandemic, and I talked a bit about the upcoming recovery, and it was totally wrong. I did have forecasts in there, but
Thankfully.
I sort of extrapolated. I said, look, if it's I discussed the low inflation, I spent most of the time discussing the low inflationary environment of the past. And I did throw my hands in the air. I mean, I hopefully said in there, I expected some inflation, but I was sort of discussing, how MMT, and if you had a slow recovery, and unfortunately we didn't have that. It's a hot recovery, so but at least the forecast was, to what extent there was a forecast and there was horribly wrong, but it at least gives you the economic history. It gives you the setup of what was sort of like from 1990 to 2020, what was the world like, and what were sort of the debates, and then boom, and things are different, but at least what I hope is, if you would say, in addition to learning what MMT is, say, how is the current environment different than the past? Because one of the problems is people, they don't spend too much time discussing the sort of the environment, and you don't really have what were the forces, like how is today different than 2015? And it's most people, like most discussions don't really go into that. And I think in order to sort of understand where we are now, you still have to say what's changed, and then you have to say, is it going to stay changed, or is it going to go back to where it was a few years ago? And maybe it doesn't go back, but you sort of have to have a little bit of context. And most people, like I do it fairly neutral, because I'm not selling a forecast. Like I avoid. I don't. So I'm not telling people this is what's going to happen. So I can sort of say, look, this is this is what's happened in the past, and then you can draw your own conclusions. So anyway, so those are like the various books. They're on Amazon. Like that's where most people buy it. But they're the other books they're pre-ordered. They're too niche to be to get into a bookstore. It's not going to happen. But they're niche books. You buy them online, and there's a few of them. Like I have one recessions, one on building models in Python. I forget how many. I've actually lost track of how many I have now. It's been basically 1 year, so it's eight or something. I've got one on inflation, but it's sort of frozen. I'm waiting. I wanted to wait for inflation to calm down before publishing it. But I might do one on banking. I started working on one on banking, but anyway, so that's where they are. But like, there's my blog, and to a certain extent, I don't. I do have references to other sources, usually in my thing, like coming up. But I'm not right now. Most of what I'm writing is drafts of what's going in the future books. So I'm not sort of reacting. It's not like the old blogosphere where you're sort of arguing between blog to blog.
Yeah.
I'm not doing that content as much. I mean, historically I did that a lot, but now it's mainly more I'm writing drafts with some topical stuff coming in. So it's more primers. That's where what I'm saying on the blog. Like on Twitter, I have a lot more. Like it basically Twitter's where I'm reacting to what other people are saying a bit more, because it's only there's a couple hundred characters. I just do that. I could just make a few points and not have a long-winded article. So my content, if in terms of reacting to things, I'm more active on Twitter. Like I have a Facebook account, but there's nothing on there. I guess if you absolutely need to contact me basically on there, someone wants to contact me, I have a public account, but it's not there. But basically on Twitter is where you, like, that's where, if you want to say, react to things, that's where I am. And my blogs are more primers.
Got it. Brian, thank you so much for a wonderful podcast. It was awesome having you on.
Okay, thanks. Okay.